So we study the relationships between stocks, bonds, commodities, and currencies. On February the 18th, the all-world market index peaked. From that point forward, the emerging markets began to underperform the S&P on a relative basis. And here in the U.S. markets, the defensive sectors of the U.S. market began to outperform the riskier or beta sectors, all while the S&P was sitting at its highs. When we next looked at asset classes, we saw that bonds were making new lows in yield, or bond prices were rising at a much higher rate than the S&P, relative to the S&P, all of which is very, very inconsistent with a bull market, inconsistent with risk-taking. And we know from our work that that in the past, that when those gaps occur, they are often resolved in a violent or dramatic fashion.
When you say summer crash, we've seen basically a lot of markets enter bear market territory, so they're down about 20% from their peaks. To some, that is a crash. What are you calling crash?
Well, we would call a crash also, it doesn't necessarily have to always be in price, it can be in time. So this, in 3 weeks, approximately $6 billion of market cap has been wiped off of world markets.
All right. So in that case, can a crash be averted if we have Chairman Ben Bernanke announcing QE3 this Friday?
Susan, I don't really know. QE2 put in $600 billion over 12 months. As I had just said, $6 trillion in market cap has been wiped out here in this past 3-week period. So we'll have to see how it turns out.
We will have to see how it turns out. Why don't you make a prediction? How's the summer going to end?
Well, what we're looking at right now, which is very troubling for us, is that the industrial sector, which was a very strong leader, has also rolled over. The retail sector, relative to the S&P, has rolled over. So that does not bode well for the Christmas season. It says to us that markets are pricing in a consumer retrenchment and a lack of consumer spending. So we think that means lower equity prices in the fourth quarter and in the beginning of 2012.
How much lower? Can you put a number to it?
Well, we think that possibly the March 2009 lows could be in play for next year.
Okay. Well, let me ask you this quickly, because going through your notes, it seems that Europe is a bigger concern for you right now than the U.S. You're saying the risk isn't that Greece pulls out of the Eurozone, but Italy and their fiscal problems might be the straw that breaks the camel's back. Is that right?
That's right. Susan, again, we look at intermarket relationships. We've noticed that, Italy is about 7% away from its 2009 low. Spain is close. The German yield curve is inverting. The DAX just had one of its worst weeks in years. All of us, when we study the intermarket relationships, these are telling us that are very, very troubling signs.